As the 2022 housing market enters Q4, many anticipate that a complete collapse is underway. After 8 straight quarters of absurd price growth, the public is exhausted. Priced out of the American dream by wild speculation, greed, and the fear of missing out. Everyone by now is well aware of the great pandemic bubble. In strong markets like Tampa, Florida, we have seen houses go from a median price of $215,000 in 2019 to $425,000 in June of this year. But it's not just prices that are breaking the back of the American consumer. Interest rates are adding to the pain. In 2021, the average mortgage rate on a 30-year fixed loan was 2.65%. Today, that same loan is at 5.75%. The truth about housing is that it's gotten completely out of control in the context of true prices. What I mean by this is that when you look at all the factors influencing the real price you pay by month to own a home, the difference between now and 2019 is absurd. Let me give you a specific example to show you what I mean. We begin with a location. Take, for example, the middle-class suburb of Riverview, Florida, located about 30 minutes southeast of Tampa. It was a relatively affordable city just 3 years ago in 2019. Back then, the median home price was around $229,000. And this specific home is an example of what you could have purchased with that kind of money back then. It's a 3-bedroom, 2.5-bath, beautiful new build. It sold in August of 2019 for $230,000. Now, the people that purchased this home would have roughly paid around $1,400 a month for their mortgage. Today, this same house is for sale once again, except this time the list price is $375,000, 63% higher than what it was in 2019. Not only that, but today the average mortgage rate for a 30-year loan is 5.84% according to NerdWallet's mortgage rate inside tracker. This means that for the next owner, this same house is going to cost them around $2,800 a month. That's 50% more. We all know that this kind of growth is unsustainable unless wages dramatically shift upwards. The masses simply cannot afford homes this expensive, and it's creating friction and division in the population. Existing homeowners are enjoying their locked-in low rates, discounted prices, and built-up equity. But for new buyers, the environment is dismal. Many, mostly younger shoppers, are either forced to wait or pushed into expensive homes well above what is considered responsible. Things have spiraled so far from reality that there is now a division developing in the market, with sellers refusing to come to terms with the fact that price corrections may be necessary. Goldman Sachs was one of the first investment banks to publish a report that predicts the obvious cooldown. This CNBC report from earlier in the week summarizes their findings. Take a listen to their unique analysis, but before I show you, please make sure you hit that like and subscribe button if you're enjoying the content thus far. Now back to the clip.
We're already seeing home prices weaken, but that new report from Goldman Sachs says growth will slow sharply in the next couple of quarters, up 8.5% quarter to quarter in Q3 and up just 3% in Q4 versus Q3. Still, that does put prices at the end of this year up 14% year over year, but Goldman is saying that next year home price growth will stall entirely, with the caveat that while outright declines in national home prices are possible and appear quite likely for some regions, large declines seem unlikely. Now, we also got the much-watched S&P Case-Shiller home price report out this morning. It's a bit outdated already, but it showed home prices in June were 18% higher year over year. That is down from the 19.9% annual gain they saw in May. And another report last week showed home prices dropped from June to July, the first monthly fall in nearly 3 years. That, according to Black Knight, it was the largest single-month decline in prices since January of 2011. And all of this, of course, has caused several economists to call a housing recession in the past few weeks. That was not taken well by the already beat-up home builder stocks. Check out the home building ETF ITB, down 6% for the month, 30% year-to-date. It includes not only big names like Lennar and D.R. Horton, but also remodelers like Home Depot and Lowe's. Back to you guys.
But maybe you're saying to yourself, this isn't that bad. If we look at markets around the world, there are plenty of places outside the United States that rank much worse in terms of home affordability. In Canada, for an example, it's not uncommon to see $1 million price tag for a regular home in a middle-class suburb. A survey by Rates.ca revealed that a fifth of Canadian respondents aged 18 to 34 spent 50 to 74% of their monthly income on mortgage payments. In comparison to the US, this makes our market look cheap. Or does it? Going back to Riverview, Florida, we can actually look up the median income for a household in that municipality, and using that information, we can truly get a sense of how bad the markets have gotten. Based on numbers from the US Census Bureau, the median household income in Riverview was around $75,000 gross in 2020. This means that a new resident paying for that house we mentioned earlier in the video would spend a vast majority of their income on the monthly payments. Remember, that house was listed for $375,000 or $2,800 a month. Well, this means that this new buyer would spend around 57% of their post-tax income on the mortgage. Not exactly all that different from Canada and the rest of these unaffordable markets. This clear example showcases the problem. There simply isn't enough money to continue to grow prices, especially as rates move up so much. Those without above average income are truly stretching their budgets to make these payments and are one bad economic cycle from bankruptcy. So far, unemployment has remained low, even reaching record lows recently, but if the economy for any reason decides to truly take a turn for the worse, bringing jobs down with it, you can bet that many of these people spending 50% or more on their mortgage are going to be underwater quickly. And with the Fed now moving away from the soft landing narrative, you can bet that the bond markets are going to react in a way to make things worse. The 10-year Treasury, which is heavily correlated with mortgage rates, is once again approaching that 3.48 level we saw in June, and if it does surpass that, you can bet that we're going to see record-breaking mortgage rates this fall. Today, it was reported that the average 30-year rate got up to 6.23%, tracked by Mortgage Daily News. If that kind of growth is sustained, we may be going back to the early 80s where we saw double-digit mortgage rates. At a certain point, this will kill prices as it destroys demand for future buyers. The argument that people used from the past is a bit outdated. Sure, your mortgage rate in 1993 was 7.5%, but it's not about the number, it's about these new monthly payments, which are a deadly combination of sky-high prices and high interest rates coming together to create what is likely the most expensive market in history. I've never seen a chart like this that goes back before 2015, but I'd be willing to bet that today's average payments are among the highest ever, even adjusted for incomes, inflation, and whatever else needs to be adjusted. How it plays out, nobody knows, but we can bet that if rates do indeed push up, eventually there will be a breaking point. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it.